community.
Thank you, and thank you for your support on this important bill. So first of all, I want to make it clear that Coinbase supports tax payments in crypto. We think that everybody should be paying their taxes, and we think that centralized entities like Coinbase should be reporting, no different than a Schwab, no different than a Fidelity. It's important value-added service for our customers. But what concerned us about the drafting of the infrastructure bill, specifically to the tax provisions, was that these are complex issues. Crypto taxation is complex, the technology has new players in the space, and that we didn't have the public comment period that we would typically have for something so complex. And so what happened was the risk of an unintended consequence. And I think that we can still solve this. I think that we are not to the place that it could be scary, but the definition of a broker was potentially overly wide and could be interpreted to include players such as miners, such as the hardware wallets that do not have access to this information, that have no ability to comply with reporting regimes, and then could be consequence. There could be penalties, there could be federal risk to them. So we thought it was overly broad. And then separately in 6050I, we thought that there was additional reporting risk that was privacy and also could be deemed overly broad and pull in parties that were not necessarily deemed to be covered by this rule.
Thank you very much. Chair, I yield back.
Thank you very much. I think you need to make a correction. You referred to Mr. Brooks as having been at SEC, and he has been saying all along he was at OCC.
I never made that reference, but thank you.
Well, all right, thank you very much. We appreciate your presence here today and your expertise in banking law. Thank you. The gentleman from Massachusetts, Mr. Lynch, who is also the chair of the Task Force on Financial Technology, is now recognized for 5 minutes.
Thank you, Madam Chair. Great hearing. I want to thank all of our witnesses as well. Prior to the creation of the subcommittee on financial services, we had a terrorist financing task force that I chaired for about 8 years. So I'm keenly sensitive to the issues around Know Your Customer and AML. And I worked a lot with FinCEN, the Financial Crimes Enforcement Network, on traditional banking protections with regard to terrorist financing and money laundering. And I know that at the end of last year, FinCEN actually issued a rulemaking proposal to require banks and money service businesses to submit reports and verify the identity of customers involved with wallets for virtual currency. And so this particular rulemaking focused on those wallets that were hosted in low compliance jurisdictions and were identified by FinCEN as wallets which were not hosted by a financial institution called unhosted wallets. And the requirements that FinCEN came up with are sort of similar to what we use now for money transmitters. So Mr. Armstrong and Mr. Allaire, your firms in particular were vocally opposed to that rulemaking. And I heard your responses to Mr. Foster and to others regarding identity. And I want to try to understand, can you share why the transactions involving virtual assets and payments involving those wallets that are quite similar to Western Union transmissions or MoneyGrams, why you objected to what looks like a fairly similar regulatory approach? Mr. Allaire, you might take a crack at it.
Thank you, Congressman Lynch, for the question. It's a very important question. First, I would simply start by saying I think FinCEN has done an excellent job at looking at the issues of money laundering, terrorist financing in the context of virtual assets, virtual currencies. They led the way as the first federal regulator to, in fact, put in place rules around that back in 2013 that led firms like Circle, Coinbase, and many others here to put in place licensing, supervision around Bank Secrecy Act, anti-money laundering provisions, and the like. I think the specific issue at hand, which you are correct, we had some significant objections to, was really twofold. One was there was a introduction of a 11th hour rulemaking that did not have significant public comment. And I think at the bottom of that issue is there are some really significant things about the way digital assets and blockchains work that we want to make sure, if we're going to be introducing rules around reporting, that they take account of the unique things with public blockchain infrastructures in particular. Notably, public blockchain infrastructures are in some ways like the public internet or the World Wide Web or email. They're open networks that anyone can connect to, join, and use. And it's one of the really powerful things that has made information exchange free. And I think it's one of the things that we believe with digital assets on blockchains can make value exchange much more frictionless for people around the world. And a part of that is that there are the ability for an individual to self-custody assets with a piece of hardware or a piece of software. That piece of software could be downloaded from an app store, and they're self-custodying a stablecoin like USDC or a Bitcoin. And that's the software maker itself is not involved in facilitating a customer transaction. They're really just a software developer providing technology that end users can use. And I think the rule as it was outlined would kind of be a square peg round hole, or a bit of a blunt force instrument. And what we argued, and I think is hopefully going to bear fruit significantly over the next year, is that what we really need are ways to provide proof of digital identities. A firm like Circle or a firm like FTX or Coinbase or Paxos or other members, other folks testifying here, could provide a cryptographic proof that someone has been KYC'd. And that proof could actually be carried around with them in a hardware wallet or a software wallet. And then you'd have the ability to know that you've got legitimate actors, to be able to have the right information about users without having essentially more PII or personal identifiable information being broadcasted really broadly. And so I think our view was give the industry more time to develop technology that can allow these forms of transactions to happen, but still preserve privacy and take advantage of the really significant security benefits that come from cryptography.
Okay, that's fair. I know my time has expired, so thank you, Madam Chair. I yield back.
Thank you. The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you also for convening today's hearing. Thank you to the witnesses. I know we've been here for some time, but it's been very informative, and I appreciate it, and I know we all do. Ms. Haas, if I could with you, could we talk about the Crypto Rating Council that I believe Coinbase and other industry players created to determine what digital assets look more like securities and which ones don't? If you could you talk to me about how the council makes its determination and who's involved in the process?
Thank you for the question. So the Crypto Rating Council is an independent entity that works to serve industry participants such as Coinbase with an assessment of digital assets underneath the Howey test. So it's looking at the white papers that new asset projects put forth and making a determination under the Howey test whether or not that new project is more likely than not to meet the definition of a security under U.S. federal securities laws. Independent law firms are the ones who are doing this assessment, who are U.S. securities laws experts, and looking at facts and circumstances to make an assessment.
Thank you. If I could ask you, could you talked about securities, can you talk about what degree, if any, the SEC and other stakeholders have been involved in, what the discussions have been with in terms of the framework?
Thank you for the opportunity to address this. So at this point in time, the SEC has not provided a clear definition about what is or is not a security. They've asked us to rely on the Howey and Reeves test, and we, companies like Coinbase, companies like FTX and others, pay careful attention to ongoing litigation that is existing in the space, news that we see, but we are left to interpret based on our interpretation of law for what is and is not a security at this time.
Thank you, Ms. Haas. Mr. Brooks, if I could to you, thank you also for being here. If I could, I think obviously there are people who believe that cryptocurrency is difficult, maybe even impossible to track. Can you talk about that as it relates to the blockchain? And while we talk about illicit activities, alleged illicit activities, oftentimes would be investigated by federal authorities, could you explain maybe the fallacy in that as if you were talking to our local police chiefs or local sheriffs?
Sure. Well, thank you for the question, Mr. Kussoff. I actually do this talk at local Rotary clubs and things around the country all the time, so I think I can do that pretty well. I think the easiest way to understand it is let's contrast blockchain transactions with normal banking transactions to see how much easier it is to trace them on a blockchain than it is in a banking transaction. So let's imagine for a moment that I would never do this because this would be flagrantly illegal, but let's say I bought you lunch, okay? And let's say that afterwards you wanted to Venmo me your payment back, right? So you hit your Venmo button on your iPhone and you sent me money. What many people don't understand is that there are 7 or 8 different steps in the Venmo transaction. So all Venmo does is send an instruction to your bank. Your bank then receives that instruction, they write it down in their books and records, and then they then send an instruction to an underlying transfer network. It could be the automated clearinghouse, could be the Fedwire system or something else. That system then contacts my bank. It inquires whether my bank has enough money to pay you. Once that's been done, then there's a debit from my account. It's very complicated. And in any one of those steps, information could be lost, there could be a breach, something bad could happen. Versus in a blockchain, there are no intermediaries. I'm not sending instructions to a third party to send instructions to another third party to eventually send you money. I've sent you money. And when the block is validated, I can see that my wallet address transferred that value to your wallet address. Simple as that. The easiest way for people to understand how easy this is, because we've had a lot of talk of hacking and cyber security issues, the reason that we found the bad guys in the Colonial Pipeline hack was because they asked for Bitcoin. If they had asked for diamonds, if they had asked for cash, if they'd asked for almost any other thing, we'd never have caught the bad guys. We caught the bad guys because, not in spite of, because they used Bitcoin, and we could tell exactly where the money went.
So the blockchain, because the blockchain was used, it was traceable.
Correct.
And just briefly, because my time is expiring, again, as you're talking to Rotary clubs, you could give specific examples where the FBI and other federal law enforcement agencies use the blockchain, in fact, to help trace and help determine?
When I used to work at Coinbase, I ran a group that facilitated those customers. They were our clients. We did work for them.
Thank you very much. I yield back.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, to Ranking Member McHenry, both of you for hosting the hearing. Mr. Cascarilla, I want to touch briefly on the risk that stablecoins might pose to our broader financial system. The President's Working Group report, which we spent plenty of time talking about today, expressed concern that any perceived instability could trigger a run-on on that stablecoin. In 2008, we saw the dangers of instability in prime money market funds, and now rating agencies are saying that. So how do you respond to the assertion by the President's Working Group that a run-on stablecoins could cause systemic instability?
Thank you for the question. I think this is a crucial topic when it comes to stablecoins. I think the key point here is to define stablecoin. And depending on how you define it, it creates different risks. If a stablecoin is backed by only cash and cash equivalents, essentially money that's sitting in an FDIC-insured bank account or sitting in T-bills that mature in 3 months, there is no risk of a run. It's liquid cash. You've taken simply $1 and you've tokenized it. And there's very good uses for that, and there's really good reasons to set it up that way. Of course, you could decide to back your stablecoin with other assets, and certain issuers do. It could be loans, it could be CDs, it also could be other types of securities. And in that case, you start to have not really a stable coin, but you have something that looks more like maybe a bank deposit. And in that case, it would make a lot of sense, I think, for a banking regulatory regime to oversee it. And also, it could be that it looks more like a money market fund because it's backed by certain types of securities, and it would make sense for the SEC to oversee it. So we are a trust company.
Okay, I was going to ask how stable coins are not similar to money market funds, but I think you've made some clarification there. So, Mr. Haas, in October of this year, Coinbase released an operational framework of the digital asset policy proposal, in which you advocate for the creation of a new self-regulatory organization. You indicate that incorporating an SRO into the regulatory supervision of marketplaces will speed the development and enforcement of an appropriately tailored digital asset industry rule. So in your view, how can Congress and industry best come together to begin laying the foundation for a successful regulatory framework for digital asset trading platforms such as yours?
Thank you so much for this question. So I want to clarify that first on our proposal, we are seeking one single federal regulator. It could be an existing federal regulator. We're not asking for the creation of a new federal regulator. And the value that we think of having an SRO would be, this is complex. There is new innovation happening in crypto every single day. We haven't even touched on NFTs or DAOs in this committee hearing today. And we think it's important that there's a nimble group that is constantly looking at the changes in crypto. And so that's why we recommended having an SRO in addition to a single federal regulator. The way that we would love to work with you all is we think this is an important step in the process. We think that this hearing is important, but we really believe that having policymakers deeply understand the technology, getting input from the industry, understanding the use cases will help craft prudent regulation here. We believe that we agree with you all on first principles of regulation, but the how we get there is going to look very different in crypto than it has in our traditional financial markets that relied on intermediaries. I think many of the testimonies on this panel have spoken very similarly about the challenges we see, and we'd love to work with you in partnership.
Thank you, ma'am. This is to all the witnesses, and it can be a yes or no. Would you commit to, as a two-time HBCU graduate, I care deeply about making sure that your companies reflect the diversity of our country. So yes or no, would you commit to sharing data about the racial and gender makeup of your companies? I want everyone, if you can, to answer it quickly, yes or no. Are you committed to doing that? All right.
Yes.
Yes.
Yeah.
We'd be happy to follow up with your office.
Well, great. We would appreciate that very much. It is a concern of not only this committee, but certainly of one of our co-chairs, Joyce Beatty, and myself, and some others. So thank you very much, and thank you for your responses. And Madam Chair, I'm going to yield back.
Thank you. The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, good afternoon. I appreciate everyone being here and certainly appreciate the dialogue that has been engendered thus far. I will admit to you my erudition on such matters is very, very low, and so I'm on a genuine fact-finding mission, not on a confirmation of my preconceived notions about how this could be used or alternatively how it should be treated by regulators. I think specifically to Mr. Allaire to start with, would you define stablecoin for me?
Sure. Thank you for the question, Congressman. There are many types of stablecoins.
Right.
There are stablecoins are called stablecoins because they are intended to hold a stable value. I think the name.
Can you clarify and be more specific? A stable value relative to what?
Well, relative to some underlying reference asset.
Right,
So
but that reference asset in and of itself may in fact be volatile, right? If I said this had 100% correlation with 1 ounce of gold,
Sure.
right? That would be stable relative to gold,
right.
but not stable relative in an absolute sense, I should say.
That's exactly right.
Okay.
So say the purchasing power of a dollar is changing rapidly with inflation, and so, or in other countries, hyperinflation, or there's deflationary assets and so on.
Right.
So the reference asset obviously has a huge
So
impact.
you brought this up, and I wanted to delve further into that, and I appreciate that. So not a lot, maybe not even the majority, some non-trivial portion of stable coins are backed by US dollars and are transferable to and from dollars, right? So in essence, explain to me the value proposition to me owning a stable coin that I can convert it to dollars as opposed to owning the dollars themselves? What's the value proposition to a consumer?
Yeah, it's a really great question. And I think it's good to use analogies sometimes on this.
Right.
It's sort of like the difference between having a postal letter versus an email. A digital version of a letter can move at the speed of the internet to anyone for free.
Right.
That's really an upgrade to the functionality of a letter, for example.
So-
Or digital music, the same kind of attribute. So digital currency dollars inherit the kind of superpowers of the internet, the speed, the reach,
Right.
the interoperability,
So I
and
think,
so forth.
yeah, net summary of that, right, is it is no different as a store of value than owning dollars, right, because it is convertible to and from dollars, but is different in its transaction characteristics, right? It can move faster and presumably at a cheaper cost of transaction than perhaps transacting in dollars. Is that a fair way to say that?
I think that's basically correct, although I'd say well-designed stablecoins are safer than bank deposits, because bank deposits, you're taking a risk on the lending book of the underlying bank. And so you have run risk, you have default risk of all of the deposits and loans that might sit in a bank. A full reserve form of money, which is what a dollar digital currency such as USDC represents, is actually a safer form to hold, not just store value, but as a transactional medium as well.
Right, assuming that you hold your dollars in a bank account.
That's right.
Yeah, there is some level of counterparty risk. We have worked hard, frankly, in this country and through a regulatory environment of minimizing that and through federal government guarantees, but that remains non-zero if trivial, right? So walk me through the transaction value of owning a stablecoin, right? And here's my view just outside of this, right? I understand the notion that if I go to a retailer that accepts that stablecoin, right, then I can transact with them, presumably at a lower cost to that retailer. Hopefully my prices are lower on account of that, and I can transact faster with them. But there is a non-zero transaction cost associated with getting into that stable coin, right? So I've kind of traded this notion